Welcome to our February Treasury Technology Briefing, part of our ongoing series. I'm Lori McCulley, and I head our Treasury Technology practice. I'm joined today by my colleague Jeff Diorio, a principal in our Treasury Technology practice. Today, as with every quarter, we'll bring you our perspective on the ecosystem of technology that enables Treasury visibility and analytics for the management of cash, trade, and risk worldwide. Reflecting on the year in front of us, we will relate our findings and conclusions with respect to the engagements we've worked on with corporate clients and solution vendors, and what we're seeing in the marketplace. A few logistics before we start. We will end in 30 minutes. We welcome questions following the webcast, but we'll reply off the air to keep the session on time. For all participants, we'll send the presentation and offer a recording of it on our website. In each of our quarterly briefings, we cover what we believe to be the most important things our clients need to know as they address their technology needs. That starts with our take on the big issues in the Treasury technology space today, along with what we're hearing from our clients in our work with respect to trends. Then we'll report on what clients are saying. In this case, it's about relevancy, and in particular, outsourcing of Treasury. In our discussion of game changers today, we'll take a closer look at issues we surfaced during our State of the Profession discussion last week, particularly with respect to the technology ramifications. In our section on the journey to Treasury 3.0, we will discuss the choices corporates confront related to system choice as they progress on the road to establishing Treasury as a financial nerve center. Finally, we want to relate client experiences that illustrate how Treasury technology projects can achieve objectives. So we'll talk specifically today about how to think strategically in implementation goals and avoiding potholes along the way. Many organizations are starting implementation projects this year, and it's critical to think about the initiative holistically. Jeff will now provide our take on the current industry happenings and relate what's going on.
Morning, everyone. Looking at the issues in the Treasury technology industry entering 2014, we find the landscape characterized by 1, relevance, 2, regulation, and 3, risk. Today, we'll follow up on the themes discussed in our State of the Treasury Profession presented last week. We want to highlight the impact of those issues for technology. In particular, we'll drill down on risk, given that many technology platforms are getting better and better at dealing with all types of risk that Treasury manages. In our State of the Profession discussion last week, Tony Carfang stated that there is a risk that if Treasury is not progressing to a more strategic state, Treasury 3.0 as we call it, Treasury could be perceived as a function that is ripe for outsourcing or not requiring investment. So first is relevancy. How does Treasury manage to keep hitting the mark? In our technology practice, it seems to start when it comes to budget allocation for spending on technology. Treasury is often low on the list for IT dollars, simply because it's not viewed as a strategic investment by the firm, or it has historically only warranted investment when regulatory or market events intervene. Even when Treasury makes the case for technology, IT and the CFO might ask, how do technology platforms help Treasury integrate with the broader organization and bring Treasury closer to customer and supplier flows for managing cash and risk? Certainly, Treasuries that deploy ERP platforms should be realizing the benefits of integration in order to answer that question affirmatively. But what if you have multiple systems, Treasury or ERP? What if you've got multiple global locations? You need your systems to address multiple regions and be very relevant for interfacing with remote users. Lately, we're seeing more technology vendors address the needs of affiliates to really communicate and provide intelligence to central Treasury and Treasury back to them. Whether it's forecasting cash or exposures, enabling in-house bank, expediting transactions and account maintenance requests, or supporting jurisdictional reporting. Second is risk. Risk is a fundamental part of Treasury's remit, but we think it's changing again. New elements of financial risk and different types of operational risk are prompting vendors to increase capabilities for monitoring and, more importantly, mitigating risk. We'll be addressing that in more depth shortly. Regulation is on everyone's minds these days, and not just because February 12th is the derivative trade reporting deadline under the European Market Infrastructure Reform Rule. We're seeing that vendors, bank counterparties, and corporates are taking different approaches on how to cover trade reporting, clearing, and portfolio reconciliation. A lot of the Treasury Management System vendors have been playing catch-up on derivative regulation as they waited for the rules to be implemented. There are three compliance components for which your technology should be ready. First is trade reporting, second is clearing, if it's interest rate swaps in Europe, and third is portfolio reconciliation. Let's take trade reporting, for example. Since the Gramm-Leach-Bliley Act in the U.S. more than 10 years ago, banks have had to follow the KYC rule, Know Your Customer. Now, thanks to AMER and Dodd-Frank, corporate treasurers must follow the KYB rule, Know Your Banks. Regulators are restricting banks in numerous ways. Banks will interpret these regulations differently, and those varying interpretations will fall squarely on the desk of the treasurer. For example, you can't necessarily assume that your counterparty banks will be the reporting party on FX trades. Some banks may say no. Timely confirmation capture of more than 50 data elements related to trade details and end-of-day reporting are now requirements for corporates in Europe and some in the U.S. At a minimum, you need to be able to reconcile your portfolio with your banks. We know some vendors can support these requirements and others can't. That might force you into outsourcing your trade reporting duties under the regulations, or some companies are finding this suits them as they don't have the technology infrastructure to support their own reporting.
We also want to take into account what our clients are saying about these subjects. We took a closer look at relevance in terms of Treasury outsourcing.
Our first question dealt with whether corporates are outsourcing Treasury functions, either to shared service centers or outside third parties.
A really overwhelming response here, Jeff. It's still the case where organizations feel Treasury is something that can't be outsourced effectively, and that maybe it is a financial nerve center.
Lori, I think it's reflective of the fact that most companies are just getting around to maturity with their shared service centers and continuing to put those in place after they've enabled a single global instance of an ERP, for instance.
Yes, I think those CFOs who are looking at the question of full outsourcing of the Treasury function are clearly leading edge. I'd want to come back to this question in another 2 years.
For those companies who did say they'd moved some Treasury functions to an outsourced provider or an internal shared service center, two of the most popular activities to shift are Treasury payments and Treasury accounting, as you can see on this table.
Yes, Jeff, clearly the rote and replicable tasks are those that can be most easily transferred. SEPA helps the payment consolidation, and the segregation of duties benefits are not to be overlooked for Treasury accounting. Too many times we see Treasury front office doing its own accounting for trades. So this is a good thing that it's being moved, but only if the shared service center has a shared platform for accessing the trades for which they're accounting.
Lori, I find it interesting that bank account management is outsourced by nearly a quarter of the respondents who said they'd move Treasury functions to a shared service center. This has historically been something centralized Treasury controls in terms of mandates and account tracking, but we're seeing more companies use their Treasury management systems platform as the bank account repository. So why couldn't the rote functions of bank account management be moved to out of corporate Treasury provided there are sufficient controls?
Yes, and when I think about these responses relative to other specific client experiences, the bottom line is that certain Treasury processes definitely fit into a shared service model, only if there are common technology platforms to be accessed by corporate and the outsourcer. Jeff, maybe the market's telling us that they're still too manual to outsource effectively. Turning to one of the big issues in further depth, we'll discuss technology and the state of risk management right now. We've been talking about risk management and technology for years now, but lately the market is truly responding in terms of diversity of functional offerings, so we thought it's time to take stock of risk management and technology tools as markets grow volatile again and quantitative easing ends.
Many people we talk to feel they're adequately managing risk, although most continue to express concerns that they could be doing better with FX risk. Volatility in emerging markets has risen again, and exposures better be accurate or we'll be seeing losses reported at the end of this quarter. Exposure capture continues to be an area where companies want technology to do more for them in terms of intelligence from business units and portfolio analytics to model market moves.
Jeff, TMS platforms are getting better at this over the last 2 years. In particular, functionality for value at risk, cash flow at risk, and earnings at risk are being deployed by many clients. True even in SAP with its risk analyzers, and again, the TMS platforms that have added risk analytic capabilities over the last little while.
I agree, Lori. And clearly, as quantitative easing is eliminated, the need for proactive interest rate risk management will come back. And valuations for trades aren't getting any simpler based on regulatory requirement, compliance situation, and accounting standards. Our clients really want technology that allows them to compare valuations in this regulatory environment.
And Jeff, we've been saying for a while that commodity risk has been migrating to the Treasury desk as Treasury takes responsibility for more of the balance sheet. Commodities risk management is significantly more complex than FX, and TMS systems have never been great at managing commodities, but that's definitely changing as solution providers add more commodities functionality. And again, I think the regulatory environment is forcing their hand.
Counterparty risk has evolved from static, notional limits calculated on a daily basis to real-time current market and scenario-based analytical exposure analysis and limits management. The technology requirements once used by banks and institutional investment operations are now required by corporate treasuries. These include simulation capabilities, real-time CVA analysis, and complex limits management.
Not only that, Jeff, corporates have been in the monitoring mode now for the better part of 5 years, or at least they should have been. Now it's time to require that your technology support mitigating counterparty risk. Regulatory compliance for derivatives may entail margining and collateral management for more companies than ever before.
Tools available to corporations are evolving to allow custom analysis of counterparty risk and limits compliance. Counterparty risk is an area many organizations are working on and looking for a holistic solution across cash and financial risk. In many cases, this may require a new version or new software to accommodate. All vendors recognize this and are moving at different speeds to meet the need to manage counterparty risk.
Operational risk is an area that historically Treasury had better be good at. It's the basics for Treasury. So why are we talking about it in 2014? Well, you've seen the headlines. You can add cyber risk and jurisdictional risk to your list of operational concerns.
Cyber risk is getting a lot of attention given the extent of systemized transaction processing and the data breaches suffered. We've heard worse stories recently related by clients in terms of wire or transaction processing. Denial of service threats have many organizations moving away from reliance on web platforms to SWIFT or thinking about the new SAP Financial Services Network to help provide redundancy in their banking activity. In addition, we have even helped organizations create backup banking capabilities to address these risks.
Moving to software as a service or the cloud helps, but heed the idiom that you don't eliminate risk, you transform it. SaaS may provide better redundancy and resiliency, but ensure that you know what SaaS really means. There's a lot of confusion in the marketplace, ASP, hosted, SaaS. Know the controls and security provisions that each vendor provides. Jurisdictional risk is what we'd refer to as what companies will encounter as Basel III potentially changes the landscape for bank liquidity products such as notional pooling, and hence the tax structures that many multinationals have put in place. Tax burdens represent jurisdictional risk, and we hope the Treasury is prepared to help their tax department think through the possible outcomes from regulatory changes in EMEA and elsewhere. The next section of today's briefing is designed to show how we're helping our clients think about how to get to Treasury 3.0.
This chart is the baseline for thinking about how choices Treasury makes for technology will advance them toward a more strategic Treasury and enable the financial nerve center. Today, we've talked about how Treasury needs to maintain relevance in the face of organizational efficiency initiatives, shifting regulatory and liquidity environments, and new risk demands. So as we look at risk mitigation from a technology standpoint, the subjects we just discussed are for the most part not in the Treasury 2.0 realm. They demand that organizations move to enhance infrastructure.
And Jeff, even operational risk, which has been around for a long time, is something most companies would say they've built enough security and bank services to combat. Plus, corporations have put in place contingency plans for disasters. But cyber risk events are forcing companies to move operational risk out on the spectrum requiring enhanced infrastructure. And this is really where the interdependency between strategic and operational elements of Treasury come into play. Getting to Treasury 3.0 means you'll have to have systems capacity to support all of the financial risk and operational risk management we previously discussed. Our final section of quarterly tech briefings is one in which we'll relate success stories about what can be painful and long projects, Treasury technology implementations. Today, Jeff and I want to talk about the risks that nearly every organization encounters over the course of projects such as these and how to plan for them. We've been talking today about relevance and risk. Technology projects are laden with risk, and we thought it might be helpful to discuss what we've seen in our implementation work so that those of you embarking on projects this year can see what lies ahead and plan for it. Jeff, what are the various types of risk that we see clients have encountered on Treasury technology implementations?
It's a long list, Lori, but here are some of the primary ones. First, unclear objectives. Second, unrealistic timelines. Third, staff turnover. Fourth, competing project technology projects. And fifth, project management unfamiliar with Treasury. Let's briefly talk about each one and how to overcome these hurdles. First, unclear objectives. Treasury management systems are like shiny new toys. A lot can be gained through deploying them, but if Treasury is not very clear about its end state goals, then timelines can be inadvertently sabotaged and the toy sits in the corner unused. Before implementation, Treasury must prioritize its requirements and determine what's most critical to have. Is legacy technology being replaced? Are there license expiry dates looming? We had a situation where one client was a spinoff and the new company had a Treasury services agreement ending in 6 months. So new functionality had to be deployed in time to support the spun-off entity. But in that case, the client was very clear about what was fundamental and what could wait for later phasing. Many clients point to year-end fiscal calendars, wanting the new system to be live for the next fiscal year. That's common, except treasurers may forget that IT and SOX audit blackout the final quarter for go live of the new system, affecting the financials. At the start of the implementation, make sure that vendors and project resources fully understand the priority order of what's to be implemented and when.
Jeff, the second is unrealistic timelines. Rarely does a client say to us, oh, we don't expect to be using this system for 2 to 3 years. Far more often is the statement, we need this up and running in 3 to 6 months. The industry is sometimes guilty of promoting expedited timelines given SaaS deployment models that don't rely on ordering hardware, or streamlined bank connectivity options that expedite getting bank reporting into the system. That's good. But no one really wants to say it's a long, hard process. Stakeholders should promote more realistic timelines to the corporate marketplace, if only because customer satisfaction might increase. But that's probably pie in the sky. So we'd say it comes back to what's most critical in terms of your requirements and how can you resource the implementation to achieve your objectives in a reasonable amount of time. In your business case, don't assume an unrealistic timeline. And at the start of implementation, this is why the scoping process that the solution providers undertake is so important. Clients need to be able to articulate to their vendors their objectives and planned phasing, and then they really need to press vendors about whether it's achievable and what the dependencies and constraints are.
Third is staff turnover, Lori. This is something that's coming up all the time in implementation projects. A certain amount of it is to be expected, just as people come and go from Treasury. But what about our clients who have rotational treasuries, where people might do a 1 or 2 year stint in the department? On virtually every project, we've seen staff turnover due to retirements, maternity leave, you name it. Throughout a project, consistency is key. But if you have to plan for enough resources to work around this disruption. At the beginning, decide who will take which roles in the project and determine their backups. That, plus well-documented design and blueprinting without deviation, will also mitigate this risk. You can't have new people coming in and changing design decisions midstream unless you're willing to move the go-live date.
And Jeff, the fourth is competing technology projects. This is actually closely tied to staff turnover and resource availability. Many projects on which we've worked have been in parallel with an ERP version upgrade or other technology initiative in which Treasury resources have been pulled in, sometimes seemingly into a black hole on the other project. Before your project starts, be sure to get a line of sight from IT on other projects that may impact your Treasury implementation, and develop a plan for when work will intersect and the resource requirements. We see too often that resource requirements are not adequately or planned out in enough detail at the beginning of a project. And this is where detailed project planning really pays dividends.
Fifth, Lori, is project managers unfamiliar with Treasury. Many of you may be thinking, I've got a project management office, or IT will provide an experienced project manager, and those resources are great. But there's so much more to do besides having weekly update meetings and staying on top of everyone. There's a difference between project maintenance and project management. Experienced PMs are like orchestra conductors. They know what expectations to set and how to coordinate the players. And there are a lot of parties involved: banks, market data suppliers, IT, the vendor, and the list goes on. They know where implementation issues are likely to surface. They can differentiate between issues where there's no cause for panic and issues where you need to go to the mat for a vendor remedy. They understand the nuances of Treasury and Treasury accounting, and their independence empowers them to make the tough calls.
We have so much more to say on the topic of implementation risks and how you can take specific steps to mitigate them. We've helped many clients on the path to success with Treasury implementations. As we help both our corporate and client service and financial services clients address and succeed with technology, we have some advice we'd like to leave you with. 1, if technology isn't covering your operational efficiencies well, you risk remaining mired in Treasury 2.0, which threatens relevancy. 2, part of that relevancy comes from ensuring ongoing investment in technology for Treasury. 3, relevancy is heavily tied to capabilities to analyze risk and then mitigate it. Technology vendors are moving to help you do that. 4, Regulatory compliance deadlines are coming early and often in 2014. Figure out whether your technology is ready to support that effort. And 5, your technology selection and implementation will face hurdles, but you must plan for persistence. Jeff and I would love to hear from you, so please be sure to send us any questions you might have, and thanks to everyone who attended. Join us in May for our next Treasury Technology Briefing.